Hey everyone, welcome back to my YouTube channel. I am Xavier Smith, and today I'm going to go over my secret 4-step strategy to pick out stocks for covered calls. So let's dive right into it. All right, so I'm just going to be going over Nike in this example because it's the one that I'm in. Okay, so first order of business, we're going to check if the stock is at a decent price. And we can use fair value and just like past history to say this. So first fair value, if you're going on Robinhood, or you can look up like Morningstar, because Morningstar is a good company for this, a good website. So you could scroll down on Robinhood and it'll say here research report, it'll say fair value, right? The fair value here is 117, right? The current value of the stock is 76.56. So clearly it has room to grow, and since it is below fair value, it's probably a decent stock, right? It's probably a decent buy anyways. And usually you'd want to get it like just under the fair value, or like a third of the fair value. Well, 2/3 of the fair value price, which that's a super good buy. That's one you could hold and get 30% off of. But also, since it's a bull market, maybe the price just got inflated a lot because everything was going up. So maybe they moved their fair value. So if we look like 5 years or max might not help us here. 5 years, right? I don't see anything wrong with Nike, right? It seems to be a company I know, and I don't think they're doing anything wrong right now. And even if they are, right, maybe if they're in a lawsuit or something, those things pass, right? There's nothing happening right now that's going to ruin the company. I hope, unless that's behind like closed doors. So here we can see it looks like it's at a fair value, right? Most of the time it is above 76.50, right? There's occasional times it hits like 72, right? But it's mostly above 76. So I'm going to say this seems like a fair stock right now. This seems like a fair buy. I would buy this any day of the week. And then second, we're going to check if they have earnings, right? Not negative earnings. And the earnings don't have to necessarily be growing because they do fluctuate over time, but you should see that they have decent earnings. So if we scroll all the way down on Robinhood, you can see they do have earnings, right? They just had an estimate of 65 cents per share and an actual of 78 cents per share. I'm pretty sure every time they actually underestimate how much earnings they're going to have, right? Like Nike probably tells someone, hey, guess we're going to have this much earnings, but we're actually going to beat it every time. And every time they beat it, their stock jumps like 10%. So people get hope again, but they're really just beating earnings that they shouldn't be, I guess. But yeah, it looks like pretty consistent earnings, and I like that idea, right? It's 78 cents per share. So I'm cool with that. I'm cool with that. Okay, then third, we're gonna see if it's a well-known company because it's probably safer if it's well-known, uh, especially if it's at a fair price and it's well-known. Like if you went and asked one of your friends, they would know what Nike is, right? But if you ask them like one of these random stocks, right? You find a random technology stock and you're like, oh my gosh, this looks like such a good buy, right? It's down 80%. No one in their right mind knows what that company is. They have like $2 million worth of assets. Like here, if we check Nike, we can check how much money they have. They have $113.94 billion market cap. Clearly, if it's above $1 billion, they're probably well known enough. That's something to check, right? Maybe check their market cap. If they have like $10 million market cap, I would not I would not suggest that. They're probably way too volatile, right? And you can also check average volume. I'd say just a general rule, it should be above a million. I don't know why, but I'd say that keeps like the volatility a little lower. Like it just should be above a million. And this is 17 million here. And then also if it's got a dividend yield, that's kind of helpful. It's just a nice little addition saying, hey, it's a safer stock. And then you can also see like if they're a well-established company, maybe more people will invest in them. And if it's got a dividend yield, you can check its dividend history by looking up like Nike dividend history, right? Going to the NASDAQ. And then we can check here, like they pay pretty consistent dividends for a long time. Actually, it's an increasing dividend over time, right? This dividend has kept increasing. So we can tell this is a stock people would be buying into for dividends. So since more people are buying and just holding, it might be a little less volatile. So that's another thing you can look out. But finally, number 4, we're going to check, like, look at the percent gain off of calls at different prices. So we've already established it's a well known company, right? It's got a good market cap. It's got a decent average volume. Well, that's a lot average volume. A dividend's always a bonus, right? It looks like it's at a good price. Like especially like it looks like it has room to grow. Like it has halved from its peak. It has over halved from its peak. So I think it's got room to grow. And then what else? Yeah, it has earnings. They're not I'm not saying they're the best earnings, but I'm saying their earnings. Still 76 cents a share. That's a while from losing money. Um, so if we look at the percent game off calls, we're going to go trade Nike options, right? Now we can see that it's at 76.49, and we might want a calculator for this eventually. So if we went up $1, I might not even go this week because it's Christmas Eve today, right? So it's a half market day, and tomorrow's Christmas, which is no day on the market. So it's really only Thursday, Friday. So that's not a good representation of these calls. So I might at least go to January 3rd. So 77 call, they're paying 85 cents, right? You can see what you want to do. If you like going a little higher, right? Like if you would rather go like 78, 79, you do you, right? I'm all for that. But usually I just go closer to the money because I want a 1% a week. And if I can get 1% or a little more per week, I'm happy with it. So, like if the stock shoots up to like 80, I'm fine with selling at 77 if I bought at 76.50. So they're paying 85 cents. So calculator, they're paying 88 cents, and you're paying 76.53. So 0.88 divided by 76.53, and that gives you, that's a 1.2 ish. Nope, that's a 1.14. So it's like a 1.1% gain, and that's in 10 days because it's a wonky week, but that's still 1%, right? I'd say for that week. So that's pretty decent. I mean, it's not bad, but then if you also get the, like if it actually executes on top of it, that's 1% premium, meaning that it can drop 1% and you're still safe. If you get the premium on it, you're getting an extra 43 cents. 43 plus 88, 0.43 plus 0.88 equals, divided by 76.59, you'd be getting paid 1.7%, which isn't bad, but honestly, I'll take it because, like I did in one of my videos, like how I'm expected to be a millionaire by 24. If you could do this with a stock and every week you get 1% or less than 1%, you get like 0.5%, 0.7%, you're chilling and you are getting massive gains, like 0.7% a week. If you could do that for a full year, like compounding on everything, you're getting like 46% a year. Just crazy. But honestly, I was looking at these January 17th because you can go out in date and you can get paid more. And I was looking, I said, okay, it's at 76.55. This $79 call looks nice, right? They're paying 97 cents. It's 24 days away, so it's a month away. But I'm fine going anywhere from like a week to like 5 weeks of a call because the longer they are, the more money you get. So I'm like, okay, that's 97 cents. 97 cents divided by 76.57. Nope. 97 divided by 76.57. So yeah, this is the most tedious step because you already found your company. Now you just have to find what call you're going to do. And I'm like, okay, that's 1.3%, but that's in 4 weeks. So that's really 0.3% a week, which isn't bad, right? You're gaining money, which is what's good. You're getting money, so it's not horrible. But if it actually did happen to execute, like that's off premium, you're getting 0.3% a week, which can get you good gains over a year, right? And get you like 20 some percent or something over a year. But if this did execute, that'd be another 246 plus 97. Clearly you can tell this is where all the math comes in. And then divided by the actual price, 76.53. So if it did execute, you would be getting 4.5%, and that would be divided by 4 because it's 4 weeks, and you'd be getting 1.12% per week, which is good, right? I like that. So that's what I look for in a company. So to recap, we're going to look for a stock that looks like it's at a fair price, right? You can look at the past history, right? Just look at like the 5 year and say, hey, does this look like it's at a good price? I'll tell you what doesn't look like it's at a good price, right? I'll show you something that doesn't look like a fair price. If I can get there, maybe something like the S&P 500, right? probably does not look like a fair price. I can show you a few things that do first. Like this, that's a fair price, right? Even though it was down here at 66 and it's at 107 now, right? Like it's up like 80%, it's still a fair price because it was sitting at 200. So that's a fair price. You probably have to look into these companies a little more if you're looking for one that's down that much. Let me just get to the S&P 500. I mean, clearly, I'm not telling you not to invest in the S&P 500 because it always bounces back, right? It always has. But if you look at it, anything that looks like this, anything that's at a peak like this, like Amazon or Walmart or something, right now is probably not the time to buy it. I'm just saying, just wait for a little correction like this. Wait for like a 30% correction, and then you can buy into it. Because if you buy into a normal stock that's all the way up here, at some point it's gonna drop. It's like Nvidia. Nvidia, I'm not too sure about. Some people love it, and some people think it's gonna tank. But I don't know. If it's up here, probably don't be selling calls on it because you could lose a lot of money on the downside. Okay, so then it has earnings, right? Just check if it has positive earnings, preferably not like 1 cent per share. Make sure it's a well-known company. You should probably know the name of it, or at least check the market cap and make sure it has like $1 billion and it's got like 1 million shares, like average volume. And then finally, look at percent gain. Like if you think it's a good company, look at the percent gain off of different call options and then just compare and say what is best for you. If a longer term call option at a little higher strike price is better for you, because you're like, hey, that's 1.2% premium. I'm getting 4.5% off my 4.5% off a high yield savings account, and I can get 1.2% in 4 weeks anyways. Like, let me take it. I'd want to hold the stock, right? And if it doesn't execute, you can just hold the stock. So that is my video. Thank you guys so much for watching. I hope this is helpful. Leave any comments or suggestions down below. Like, let me know if I need to make these videos shorter because it's running up on like 12 and a half minutes now. So I hope to see you guys next time, and thanks for watching.